Is there a bull case to be made? I mean, just this morning we heard from the trifecta of bank CEOs, Jamie Dimon, Brian Moynihan, and David Solomon, about the caution that they are, operating their business with going to 2023. So, Carrie, let's start off with you. Is there a bull case to be made when CEOs are battening down the hatches, so to speak?
Hi, Melissa and Jenny. It's great to be here with you. I think there's a difference, first of all, between how CEOs of very large banking companies view their world currently and over the next year and what the market is going to do. Because remember that the market leads. The market always anticipates slowdowns and recoveries. That doesn't mean that companies are going to be reporting great earnings over the next 6 months or 12 months, but there's a point at which stock prices and valuations determine whether we feel that the market is attractive enough to buy. So, let's make sure that we all understand, and I think we do, that there's a distinction between the economic reality and what the market is seeing for its future, because it anticipates and tends to forecast what's coming next. I mean, remember that the market bottomed on March 23rd of 2020. That was after it had fallen 34%, and we hadn't even locked down for more than a week. That was the beginning of COVID, but it was the beginning of a bull market. So I think that it is possible that the market can rally, although I'm not saying it will. But yes, you asked the question, is it possible? And yes, of course it's possible, because it can anticipate what comes after this slowdown in earnings.
Sure, and I'm sure that's what a lot of long-term investors have in mind when they're coming to the table now with their cash, Jenny. And so how should we think about that notion about the market being, discounting what the events in the future? So do you think, close to discounting, what many CEOs see as a foregone conclusion, some sort of a slowdown, whether it be mild or severe?
I think this is where we just need to back up for 1 sec and get into some nuance. So cash is no longer free. And when cash is no longer free, that statement, is there a bull case for stocks still alive? The answer is it no longer applies to all stocks. And so when you talk about certain CEOs, the reality is, and I was just on halftime and Jim was just talking about this, Ed Yardeni's been talking about rolling recessions for a long time. So we've had recessions in semis. We were having a recession in housing. Airline travel and hotels are booming. And we can look at that and we can say everything in this market right now is moving asynchronously. Even if you look at technology, even within technology, the asynchronous moves in technology are tremendous. So there's a huge difference between a Salesforce and a Snowflake and an IBM and a Cisco. So when you're asking that question, Melissa, I don't think that we can answer it broadly, and I think we're doing a disservice if we try to. I think we need to, right now, be very, very granular. And when you talk about the CEOs and how their companies are doing, that's a very different question for Bob Baskin than it is for the CEO of JetBlue. It's a different question for all the CEOs who are presenting at the Goldman Sachs Financial Services Conference right now than it is for the Marriott and the host hotel CEOs. So we really need to be careful not to lump this all together right now.
So how, Jenny, just to follow up on that theme, how do you think about the rolling recession and which sectors have sort of come to correct for that? I mean, it sounds like you're almost talking about multiples. Higher multiple stocks have come to grips with that reality that cash is not free anymore, simply because they have higher valuations. And we've seen that sort of correction or ongoing correction in higher multiple names, like the software stocks, for instance. So how do you think about what has already discounted that and what has not yet done that?
Well, I'll give you a really good example. So recently in our portfolio, we added Kohl's stores. Now, initially, I'd bought American Eagle back in May. And the thesis on American Eagle was that the share prices had already discounted and already corrected for a consumer that was basically going to lay down and die and never spend again. So we added American Eagle around $14. Unfortunately, for me, because I'm a dividend investor, they cut the dividend. I had to sell it. I replaced it with Kohl's. But when I stepped in and looked at this, these stocks were up about 20+% off of their lows from a few months ago. They're still down 40+% year to date. What's really interesting here is as we get more into these kind of really cheap, and by cheap I mean the share price, these really cheap retailers, and you start to think out to next year and you think about the recession, the consumer, but then what the share price has done in advance of that, what you see is the share prices, I think, already discounted an incredibly weak consumer. Trading at 10 times earnings with a 6% and change yield for Kohl's has already assumed everything's going to wrong. They've got $3 of earnings expected for next year. But once you talk to the company, what you hear is, hey, we actually have had enormous headwinds for the last year in terms of supply chain issues and inventory issues. Those will be gone for next year. So those will actually become tailwinds in next year's earnings versus 2022 earnings. So there's all this nuance and granularity, but that's one example of an industry, not even a sector, right? Because that's within consumer discretionary. So I don't even want to say consumer discretionary is a great sector, but I can say retailing has opportunity. And then you need to suss through that and see what works for you.
Yeah. Sorry, continue.
No, I was just going to say one other thing that was really frustrating for me on American Eagle was that investment thesis in May actually played out, and the share price is up significantly from May. I still had to sell it because of the dividend. But so that even that really shows you that you need to look at management team to management team and what the dynamics of each business are and what the boards and what the management teams are actually standing behind.
Yeah, Carrie, I think that you would probably agree that this is even more so these days a stock picker's market. So it's much more important to go by stock as opposed to sector by sector, because as Jenny had pointed out, even within each sector, there's so many different nuances. We have a market that no longer trades like a monolith, the monolith being fueled by free money, basically. And we have a much more selective market. So where are you finding the most opportunities? How are you looking at what is defensive, what is cheap? How do you suss it out?
Well, there's two important elements to this that are critical right now, and Jenny knows this very well, as do I. The market has days where it's totally risk off. They don't want to touch anything that they think is risky, and they would much rather own, a consumer staple like Coke in the mid-20s multiple than own a name like Google, which sells for 16 times next year's earnings with enormous amounts of cash and very high margin and sustainable growth that's twice Coke's. They'd rather own Coke. So you have to have a portfolio that has some of both. I mean, we are more growth investors than Jenny. We don't have any dividend requirement. And we therefore would say you have names in the portfolio such as Booz Allen Hamilton, O'Reilly Auto, Waste Connection, steady growers that the market likes, that the market feels comfortable with. They're mostly domestic customers. And then you have some companies that we think offer great value. Google is an example. It's 16 times next year's earnings. The multiple was, 26. The largest 20 names in the S&P in November of 2021 were selling at about a 29 multiple of forward earnings. And those same companies, are selling at 21 times next year's numbers, and those numbers have gone down. So we think there are opportunities within that group. Jenny probably would disagree, but we like Google. We think that Meta is attractive at 10 times. I mean, it's having a bad day today, but it was up, over 20% in the last couple of months. And we like names that we see free cash flow. And perhaps, they're having a recession too because of advertising. You look at the advertising sector across the board, those stocks are down anywhere from 30 to 60%. And so we say, here's something we think is attractive. A name like Align, which is a dental product technology company that makes the Invisalign, liners that lots of people, lots of adults tried during the pandemic. And that company has an enormous growth potential, but it went from 700 to 200. And we were looking at it all the way down. We never bought it, and we bought it recently because it's now, 25 times next year's earnings. And it has China as a headwind, but eventually China is going to start to open up. They have a nice market in China, and when we see that come back, we think the stock will go higher, and we thought this is the time to buy it. So, as we're pointing out, there are opportunities in sectors and in stocks that have had their own internal recession because of what's happened with the pandemic or coming out of it or reluctance or whatever the factors that resulted in weak earnings. And we can say at these prices that there's something to look forward to, even if Jamie Dimon is feeling uncomfortable with what he sees as the next year.
Jenny, how do you, I think that the notion of growth versus value is interesting and may be turned upside down a little bit after the market moves that we've seen. As Carrie had pointed out, a name like a Coke trades at a higher multiple than an Alphabet. And so, at what point, Jenny, would you say some of these quote unquote defensive stocks are no longer defensive because of the runs they have had, that they're not going to offer that safety for investors, or will they continue at that higher multiple to be as safe as they were prior to their runs?
Okay, so one of the things that I love so much about Carrie, and having become friends with her over the past 4 years as I've been on CNBC with her, is that even though her strategy is growth oriented, and my dividend income strategy is value-oriented. And by the way, one side note, we manage a disciplined growth strategy at Gilman Hill too, so we actually have overlap with you, Carrie, on a lot of names. But my focus is on the dividend strategy. But Carrie said something super important when she was just talking about Google. She said it offers great value. And I think what's happened as index investing and passive investing has become so prevalent in our society is that we've kind of forgotten what growth and value mean. Right, and we've said, okay, you've got the S&P 500, it's 500 stocks. Let's draw a line, and anything under this multiple is value stock, and anything above this is a growth stock. But the reality is Carrie and I are doing exactly the same thing, which we are looking for value in what we buy. And by that, what we mean is we're looking for stocks that are trading at a lower price today than we think they're actually worth today and in the future. And so while we buy different stocks for her growth strategy and my dividend strategy, we come at it in the same way, which is to say, what is this company likely to earn in the future? Where, what are the cash flows that'll come into that? So that's kind of where my head is on the big philosophical side. On the value versus growth side and putting it back in the boxes, it's an interesting thing. There's actually been, one of the wonderful things about this 2022 year is that there's been reconciliation of excesses, recalibration of craziness, a mean reversion in a really functional way. So right now you have value stocks, which on average are trading at about 20.5 times. And by the way, their long-term average is about 20.5 times. That's great. Value stocks are still technically undervalued relative to their long-term averages. Value stocks on average are trading at about 12.5 times. Historically, they've traded about 14 times. So, if you want to put it in boxes, you've got that. But I think we're getting back to a place that I remember from coming out of 2003. And Melissa, this gets exactly into your Coke example, where, where the line between growth and value really started to blur. And back then, people were using the term GARP, growth at a reasonable price, a lot, but it really became growth and value were really in the eye of the beholder. And so one of the fun things in anticipation of this call, of this meeting, Carrie and I both gave some notes, and it was really funny because we both said, here are industries. In Carrie's case, she said, stay away from, and those were healthcare, staples, energy. And I said, hey, there's opportunities here. But when we look at staples, and this gets to your Coke exactly, I look at staples and I say things like Procter & Gamble and General Mills are overvalued and too expensive because there's been that flight to safety. But I can look at Unilever and B&G Foods, which are in the same sector, and say, actually, to me, they still, to use Carrie's words, offer great value because I think they're trading at a discount to where their future cash flows should imply that the share price should be, or the money that I make off of the dividend income from them, just owning it here and now today. So I think the lines are blurry, where they've been very stark for a long time. For 5 years, they've been very stark.
Carrie, it seems like it's very important for clients, for investors to constantly examine or re-examine their portfolios to make sure that what they think are going to be the ballasts for their portfolio, the sort of more defensive names, are still going to serve that purpose after they've had tremendous runs. And not to pick on Coca-Cola, that's not what I want to do, but that may be one example, but a lot of these staples have had huge runs and multiple expansion, and they may not be what people want them to be at this point in time versus when they first entered those positions.
Exactly. And as I've said many times on CNBC, nobody rings a bell and tells you when to buy and sell. And what can happen if you own too many of the stocks that have been the most defensive, and they've been great stocks. And I applaud everybody who has owned just heavyweights in the oil stocks and the consumer staple stocks, food stocks. At a certain point, they'll start to underperform because there are cycles to markets, and that's what happens. And the underperformers will begin to outperform, depending on price and valuation. So we have made some decisions over the past year. In fact, they've been wrong, where we've trimmed some of our best performing names because they've kept going up, and we've added to some names that have been underperforming. However, you have to keep doing that in our business. You have to keep making decisions which, on the margin, look to be the best use of the capital you're managing. And eventually, there will be a time where no one is going to pay, 34 times earnings for, McCormick. It doesn't trade at 34. Well, it might trade at 34 this year, not next year, but it's still high multiple stock. And you can't anticipate when that's going to happen, but you have to have names in reserve. You have to have other names that are selling for lower multiples that you think over the next couple of years, when the market is anticipating a different type of economy where we're not so risk averse, that those stocks will begin to outperform. I'd just like to make one other point that we do. I think all portfolio managers who have some sense of kind of rationale and cohesiveness for their clients try to have some diversification in their portfolios. It's not as if we're trying to own just sort of defense and drug stocks or just communication services and technology. That's not what our mandate is. We're trying to beat the market in a diversified way because that is what our clients want us to do. And it's the appropriate strategy not to go way out on a limb, either on the risk spectrum or too overweight in any one sector, because when you're naked a sector, you can just get destroyed if it runs away. So I just think what we're talking about is sensible investing and making sure you update your portfolio at all times without trading incessantly, which is not anything we do, and it's not anything that my good friend Jenny does either.
Right. We do have an audience question, and I think this one is geared towards Jenny. So it's a mouthful, Jenny. So listen carefully. When selecting dividend stocks for that portfolio, do you consider whether a stock pays a non-qualified, non-QDI dividend like a REIT might pay, and discount that versus a stock that pays substantially QDI dividends for your client portfolios?
So long question, easy answer, yes. But so that you see that happen naturally in the REITs as it is. So I'm trying to think of a really good example. Okay, some REITs, I'm trying to think if there's like a tower stock REIT where there's also a tower company that's not in the REIT format. But what you see is the real estate investment trusts where you pay ordinary income on those dividends tend to have such higher yields that the yield in and of itself offsets the tax that you're going to pay on it. But the answer is yes. And so my job, and it was interesting, I just want to get back to one thing Carrie said. Carrie said her job is trying to beat the market. That actually is not the primary objective of the portfolio I manage. The primary objective of the dividend income portfolio that I manage is to generate a 5% or better dividend yield. So in creating that and knowing that my clients, if they give us $1 million to invest, they are counting on $50,000 of income, I am very conscious of the after-tax return on that. So if I've got a REIT that's yielding 4.5%, it's not really that attractive compared to something that, something else, another REIT that might be 5.5%, because I know that I'm getting that tax haircut. So you need to be conscious of that. I think just one other riff on this, which is, I think one of the nice things about knowing Carrie and working with Carrie is we both know our clients really, really well. And so when Carrie was talking before about taking reasonable risks and not trading a portfolio like crazy, part of the reason we both approach portfolio management that way is because we know the end client and we know how much pain that tax bill at the end of the year creates if all you do is churn and create capital gains. So.
Yeah, that's good point. Good points there.
Definitely.
Carrie, I want to also ask you about just where we are. We were talking about valuations, and if you have a longer-term perspective, are we going to look back on this year and think these were generational opportunities? I mean, I guess the pandemic presented a generational opportunity. We got too many of these generational opportunities in the span of just a few years. But are we going to look back and think, Apple, in the 140s, that was a no-brainer? Or it seems like a no-brainer. I don't know. What's your take on where we are with particularly big cap tech stocks?
Yeah, so that's a great question. And this, the last 3 years have given us just a market, whatever we want to refer to it as, something that is so far from anything that we had ever expected because of the way we've had to think about the future, not knowing anything about how we would work, live, educate our children. It's socialized. This has been an extreme, and I hope it's unique just from that perspective. In terms of looking out over time and saying there were so many stocks that were for sale, yes, I think that's true. I really do. I look at charts just the way in 2020. I mean, I lived through that in just, the extreme. I managed a growth fund. So many of the names that were in that growth universe, most of which luckily I didn't own, but did own some of them, went down, 80%. Many of them disappeared. Perhaps most of them disappeared. However, the ones that survived were some of the greatest winners in history. And I believe that if you can think through the long term for companies that have just great potential and are sustainable and that have fallen tremendously, the way the energy stocks did. Think about where the energy stocks were in the first half of 2020. Once in a lifetime opportunities for many of those. And there are great opportunities in communications and technology, and even in, the consumer discretionary, transportation stocks across the board. You just have to make sure those are companies that are going to be around and they have the balance sheet to support it, and you believe that they have clients and customers that will be buying from them 5 years from now and not just 2 years ago.